The negative gearing changes that could make you millions or cost you everything depending on which side of the strategy you're on. Most people think that the biggest risk with the negative gearing changes is paying more tax. But the reality is that investors who understand what's actually shifting will use this moment to pull so far ahead of the pack that the tax changes become completely irrelevant. Now, I've helped over 300 Aussies purchase more than $200 million in property, with over 50 million in capital growth achieved and counting, using the Buy Fair investment blueprint strategy. In this episode, I'm going to break down exactly what the negative gearing changes mean for Australian investors in 2026 and give you the complete investment types and structures you need to not just survive these changes, but to genuinely thrive because of them. Now, key point number one is what the negative gearing changes actually mean and what the media is getting wrong. Now, before we talk strategy, we need to get crystal clear on what has actually changed, because I promise you, the media coverage on this has been equal parts sensationalized and sometimes misleading. Now, negative gearing, what does it actually mean? Negative gearing is pretty straightforward. It's when you own an investment property that's generating rental income for you, and the costs to hold that investment property exceed the rental income that you're generating from a tenant, is a loss that you're able to traditionally claim as a tax offset against your taxable income. Now, since the budget announcements have came through, and from July 1 in 2027, if the laws pass, these costs or these offsets will now not be able to be claimed when you're buying an established property or through certain entities. So this is a big thing and actually makes a big difference as to what the cash flow looks like on investment properties moving forward. Now, the government have limited concessions for some investors, meaning that not all investor types are going to receive these changes. Some are going to be able to still use the same investment methods that they used in the past, like new homes, for example, or buying through a self-managed super fund, for example. However, if it's a traditional purchase of an established property, this has now been removed, which is a big loss. Now, uninformed investors can panic and often exit the market. We've already seen that in recent times. We've already seen that with clearance rates on auctions across the country dropping dramatically. But I'm quite confident this is going to generate some really good opportunities for people who are able to adapt and understand what the changes mean and use them to their advantage, as opposed to panicking and just giving up on the housing market altogether. It's the adapters that always build the most wealth. We are seeing people that are able to learn from the changes, who are able to study the changes, who are able to make the most of taking approaches that are going to benefit the changes that have come in, that are the ones that will benefit the most in the long term. It's always the same thing. Look at the movie The Big Short. The market crashed, the housing market crashed, and it was the ones that were able to learn from that made the most money. Now, unfortunately, they were betting against the housing market. I don't think that's going to happen again here. Hopefully not. But it's the ones that were able to adapt and understand what was going on that built most wealth. So whilst the rules have changed, the game has not changed. It's still the same approach. You just want to approach it slightly differently to be able to make sure that it's aligning with the new rules that have been brought into place by the government. There's plenty of opportunity available, and it's hiding inside the details. So you're going to need to be a little bit more specific with the approach, as opposed to the past where probably people could go in with more confidence that it was just going to be a good investment regardless. So that's the first thing, understanding what's changed and understanding how it can affect the decisions that you make with the properties that you choose to purchase, which is key point two, and it's the properties that get hurt the most and what we're probably going to want to avoid right now, especially whilst we understand what's happening and we see what kind of impact these changes are going to make. Now, not all properties are created equal under the new rules, and this is where strategy becomes even more and more critical than ever before. I do talk about strategy in these podcast episodes quite a lot, so I think that that's going to become an even bigger part of what we do, because if we get the strategy right, it can really pay off for you and you can avoid some of these changes that have been made. Now, the first type of property that's going to struggle is the one that's really, really dependent, or mostly dependent, on the tax benefit. Meaning that if we don't get that tax benefit at the end of the financial year, or during our pay cycle if we've done a variation, then the property is simply not going to stack up. And we have to see a very strong return from a capital growth standpoint, which may occur, but if it doesn't, then it's a property that's just pulling money out of our pocket. So what kind of properties are these? As I've said before, it's the established market now. It's the established property that's been built and has an owner already after May 12, 2026, that will not be able to claim these losses and these offsets moving forward if the laws get passed. So if it's reliant solely on the negative gearing component for you to justify buying it, that type of acquisition is going to be really, really hard to justify moving forward, and probably something that's going to slow right down. The second type of property is high-end properties in low growth markets. So more expensive properties that are in areas that are much more reliant on the economy and the share market to be doing well. Not that the rich or the wealthy generally need the tax offsets as much, but they are in the highest tax bracket usually, which means that they will get the biggest return from these kind of properties. And there is a big gap between the cost to manage the property and the rental income that it's bringing in. So that kind of market I could see being really impacted, because all of a sudden the investor in that space won't be able to make a purchase justifiable, because it's not going to get that huge tax offset at the highest taxable income. 47 cents in the dollar they're probably paying from a tax standpoint. And that will make a big, big impact as to how the numbers look before and after tax on a property of that nature. So I think higher end properties in these low to medium growth areas that can do really well, I think that we will see an impact within that market. Now keep in mind, guys, there are markets within markets. So this is important to understand. It's not just the housing market. There's pockets and sub-pockets and different categories within the housing market that we can look into, which as an investor is great, because you're not limited to a geographical or a singular approach that you might be if you're needing to live in the home and it's something that you want to occupy. The third type of property will be older, established higher maintenance properties with poor fundamentals. So regional locations could be affected as a result of this. Properties that need a lot of maintenance, properties that need a lot of fixing, that won't have access to depreciation like they did in the past because they're older and that depreciation has worn off. So, pre-1990 houses, for example, which generally could have done quite well from maybe a subdivision standpoint, which is also an interesting point that we can look at with these properties. If they don't have the ability to enhance the value with an extra property on an extra title or something along those lines, I think that you'll find that this segment of the market really gets affected. So older properties that need a lot more maintenance, that don't have access to depreciation in areas that don't have good fundamentals, I think you will probably see a really good drop off in this space, and I think we could see markets or prices adjust, but it will be interesting to see how it plays out, and only time will tell. The next type of property that we would look at is properties held in the wrong structure. For example, you might go and choose to buy a property in a trust as opposed to buying a property individually, and you might not be aware that buying that property in that trust doesn't give you the tax offsets that you would as an individual. Another example might be that you want to purchase in a self-managed super fund which has not been impacted by the latest changes, which means that you could actually get a much better outcome, even if the property doesn't perform quite as well as, say, another property option that's been bought in a different structure, and the end outcome could be a lot better. For example, if you're in accumulation phase with a superannuation fund or a self-managed super fund, the tax that you pay is much lower than what you would pay as an individual. If you have that property in pension phase when you're in retirement, there's a good chance that you'll actually pay no tax at all. Now, those kind of impacts long term, when we understand the numbers around how this is structured, can make a very, very big difference in the outcome that you generate over a longer term period. So properties held in the wrong structure, structuring is going to be really important now. Depending on the type of property that you're looking to purchase, will depict what kind of structure it is that you need to put that in now. And I would definitely recommend working with an expert or a financial planner / accountant to understand that. So I would always ask, in finishing off this little segment, I would always ask, will this work without the tax benefit? And if the answer is no, then you probably have a problem that needs to be fixed. And it might mean that you should not go ahead and acquire that property, as opposed to if it does work with the tax benefits. So key point number 3, and this is something that we really specialize in at Buy Fair Property Group, is a shift towards more positively geared properties and cash flow positive investing. Now, the most important strategic pivot that smart investors are making right now, in my opinion, is this shift that I believe will define the wealth gap between investors over the next decade. Now, the thing that we get when positively geared properties come into play is that we don't have as much reliance on the capital growth outcome. Obviously, we still want capital growth because we can use that to expand into more assets, but it just takes that pressure off us. It also takes the pressure off us to have to be working the whole time to hold the asset. If we know that the property's income is more than the costs to hold that property, which might even contribute towards paying it down faster, paying the debt down on that faster, then we know that we don't have as much pressure to fire sell it. which means that you're selling it under duress when you don't really want to sell it. So the old school approach of just looking at a negative gearing approach, has probably shifted. Now, in saying that, with positively geared properties, if they're newly built homes, you're still going to get access to all of the tax offsets that can come into play. Now, you will pay tax if it's positively geared, but if it's a new home that you're acquiring that is close to neutral, even if it's a slight loss, you will still get those negative gearing impacts that have been changed in the established house market. So what positively geared properties also do is it actually strengthens your borrowing position for the next property. If you go and buy a property that's heavily negatively geared, it's going to affect how much money the bank will lend you with your next acquisition. And it might be the difference between you finishing or retiring with 2 or 3 properties as opposed to retiring with 4 or 5 properties. Now, this is really important, going back to the last step where we talked about structure, getting the structure correct from the start, and then acquiring properties that generate stronger rental incomes. Now, there's different ways that we can do that. Location's very important, but probably most importantly is the design behind the new home that we're building for you so that we can generate extra income. For example, we've just started building dual key homes within Victoria, which has previously not really been allowed or very hard to do. And now, as opposed to generating one rental return from that property, we can lease it out to 2 different families underneath the one roof where they get their own separate property and 2 incomes for the investor. This is going to be an extremely popular approach to investors moving forward, in my opinion. And it will add value to the asset as well. When you're generating a stronger return, remembering that investments is about numbers, the value of that asset is generally higher when it's generating a stronger return. So building cash flow positive portfolios as opposed to cash flow negative and claiming the offset tax advantages is really going to be a big player in the investment space in the near future and for the long term to come if the changes that the government have made get passed into law. So yield versus growth, touched on that many times before. It's a bit of a damaging myth. We now want yield and growth. It doesn't have to be that it's just yield. We want yield and growth. But if we've got the yield, we know that we're going to be able to hold that asset regardless of what the performance of the value of that property is, which, to be fair, no one can actually predict. The housing market is a big thing. I don't care if someone says that they can predict what the housing market's going to do. I would challenge that, even though we're always pretty confident that it's going to do quite well. So raising rents, this is going to make it harder for tenants, the changes that they've made, and I don't know if that's been really thought through. As I said previously, with the types of properties that we can put you into, you don't necessarily have to raise the rents. It just means that you get a better return because you're providing more value in what it is that you've actually provided or built for them. So looking to rebalance your portfolio towards higher yielding properties now and new homes now that are structured correctly is going to be a really, really important thing if you want to retire with more assets than what you think might be possible. If you're listening to this and you're feeling a little overwhelmed, or maybe you're looking at your current portfolio and wondering whether you're positioned correctly for the changes, that is exactly the conversation that my team has with investors every single day. We work with Australians at every stage of the property journey to help them understand their current position, model the impact of policy changes on their specific situation, and build a clear strategic plan forward. If you're interested in understanding how to build wealth for yourself through property, there's a link below in the description where you can book a call with my team to see if we can help. Now, key point 4, the structures that win underneath the new rules. Now, this is going to be really important moving forward because, as I said earlier, it's the structure that's going to be critical in the outcomes if we play the game by the new rules. Now, here is where the investor playbook gets genuinely exciting. Because while the negative gearing changes have reduced the tax benefit for individual investors, especially at high marginal tax rates, they have simultaneously made alternative ownership structures significantly more attractive. Family discretionary trusts, split income, lower tax. Now, there have been some proposed changes to this as well. So the family discretionary trust might not actually be as appealing as what it used to be, because what the changes are proposing is that they're not going to be able to allocate the funds to family members like we were able to in the past. So I would say that the family trust is probably going to not exist to the same level as it has in the past. And I would say that more people are probably going to steer away from that. The company structure, I think that you'll find the company structure is going to be much more appealing, looking to set up a company, a trading income that you can acquire assets at. And the main advantage to that is because it's going to be taxed at a lower amount. Generally, under the company structure, you're taxed at 25%, which is a lot better than, say, 47% if you're in the highest income bracket as an income earner. We know that income earned or earned income is always the highest taxed environment that we can operate within. So if you're able to set up a company structure, you can set that up with an accountant if you don't already have a company structure set up. We know that the advantages that can come with doing that could be quite substantial when you look at 25% tax being almost half the amount of tax that you're paying on a 47% tax rate. Now, the big one for me, in my opinion, is that acquiring more properties via self-managed super funds or SMSFs is going to be very, very popular. We're already getting a lot of people inquiring with us about doing it. Please make sure that you seek independent financial advice from a licensed accountant or financial planner before setting up a self-managed super fund, because it is very, very important that you understand how it works, what's involved, what the impacts could be to your retirement in the future, and what the rules and regulations are around using a self-managed super fund, especially when it comes to acquiring property. Now, just talking on some of the massive advantages that you get access to when it comes to acquiring property via self-managed super funds is mostly the tax benefits. Now, tax benefits, 15% is what you pay within a super fund. So when you're paying tax on rental income, 15% once again is a lot better than 25%, which is the company tax rate, and 47%, which is the highest earned income tax rate. So when we're talking 15%, and this is in accumulation phase, which means that you're still working, you're still acquiring and accumulating your super, it's 15%. When you're in pension phase, this actually goes to zero. Now, this is a huge advantage. If you have a property or an asset held in a self-managed super fund via a bare trust, and that property has no debt left on it when you hit retirement, then all of that rental income that you're generating, you might be getting $1,000 a week in rent coming in, will be tax-free. And that's a huge advantage for you being able to set yourself up in the future when it comes to building a portfolio. Now, also the capital gains components to that is that you get advantage in that respect as well. Capital gains tax is generally 30%, but they will actually still provide the same 50% discount to those properties under self-managed super funds moving forward in accumulation phase, which means that you'd only pay about 10% capital gains tax. And if once again you're in that pension stage and you're selling the property as a property that you own in your pension stage, you pay no capital gains tax, which is just a huge advantage when it comes to positioning yourself for success in the future. And this is long-term success, not short-term success. It's not a get rich quick. It's about setting yourself up and thinking ahead for a rainy day. Now, there are restrictions that apply to utilising the super fund to acquire property. Firstly, you cannot live in the property. It must meet the sole purpose test requirements, which means that it's purely for the sole purpose of investing and not enjoying from a personal standpoint. And there are a lot of rules and limited recourse borrowing arrangements that are very strict when it comes to borrowing. For example, you can't borrow from a self-managed super fund. You need to set up a bare trust and borrow through that. Hence why the structure is incredibly, incredibly important, and why you need to speak to a licensed accountant or financial planner when setting it up. So structure now is more important than ever. We really need to understand how to take advantages of these changes to structure requirements, because if you can do that properly, it's going to make a massive difference to the end outcome as opposed to what it might be if you set it up in the wrong structure. So I'd really encourage, review your ownership structure immediately, speak with an expert, speak with our team if you'd like. Our finance teams can help you assess your existing portfolio and the way that it's structured, and we can also advise upon or help you get some advice around structuring it for the future if that's what it is that you wish to do. Key point number 5, new builds and complying developments. So the tax advantages that remain. Now, there have been no changes, and here's a strategy that many investors don't know about, and one that becomes even more powerful in the context of the negative gearing changes. Now, government still incentivizes new residential dwellings, and the main reason why they're doing that is because they don't want to limit the supply of the amount of homes that are being built, which would probably put a lot more pressure on top of the housing market prices and make it harder for people to get into properties, and there would not be enough rental properties available, which would cause a rental issue. Now, so considering that all new homes are still incentivized under the old negative gearing changes, changes and also the capital gains changes, this could be a really, really smart way for you to be able to build your portfolio in a more effective way. Now, previously you might not have been interested in building because you were worried about build turnaround times or insolvency concerns, or just not getting what it is that you thought you were going to get. And that's sometimes what can happen when you're building, especially with builders that aren't reputable and can't deliver on what they say they will. If you work with someone like us, we work with providers where we've seen time and time again over a long period of time that they will deliver. So that might not have been something that you were previously interested in, but it might be a really big change that you're open to now exploring so that you can get all of those benefits. Especially if you're in the higher tax bracket, as I mentioned earlier, this can make a really, really significant difference to the before and after cash flow holding costs of an investment that you've acquired. The second thing with new homes is that depreciation are significantly higher. Fixtures and fittings and diminishing assets over the first sort of 8 to 10 years, can bring in a considerable tax offset for you, but you can also claim 2.5% of the value of whatever it is that you build over a 40-year period, which actually means you can offset 100% of the value of what it is that you've built over a 40-year period. Now, these are substantial tax benefits that really become important when it comes to investing moving forward, because if you don't know how this works and you don't know how to take advantage of it, I have seen lots of investors invest in new homes and not actually submit a depreciation schedule, which is a huge issue. So if you don't know how to do this and how to set it up properly and how to benefit from it, then it will cost you a lot of money, especially over a 25, 30, 35, 40-year period. Now, pre-1987 properties have minimal depreciation left. Homes that are 10 years old and longer generally don't have those fixtures and fittings that you can depreciate anymore. So it's the new home that will really benefit from that depreciation schedule and will make a big impact, in my opinion, as to how the numbers look. Keeping in mind that depreciation is the only free tax offset that you get. You don't actually have to pay for it first, apart from a depreciation schedule, for you to be able to claim it. You just claim it at the end of the financial year and away you go. So it's very good. Now, I think house and land in high growth corridors, it might mean spending a little bit more on house and land than what you would traditionally look at doing, but as providing that you're in a high growth corridor, that will be important, because the numbers will look a lot better if we've got confidence that the property will grow in value, which is pretty straightforward in itself. The challenge with new homes that I do see there being a potential issue with is that when the investor who builds the new home, if they want to offset that or they want to sell that property and pass it on to the next investor, based under the current rules and regulations, will not get access to those negative gearing benefits. It will only be the benefit of the new home and the original owner itself that takes advantage of that. What I think is important to add to this is that the emphasis on not selling has just gone up even more, especially with the capital gains tax discount rules that are coming into play. It's going to be very, very important that you hold the assets for as long as possible and ideally never sell. Whereas in the past, I would say that selling can be a reasonable thing to do, providing that you know why you're doing it and it benefits your position. So dual income properties and duplexes, this is another thing. Properties with a home at the front, granny flat at the back. It might be a dual key home where we've got two individual floor plans under one roof with a fire protected wall in between, two kitchens, split utility tools and whatnot with wiser systems so that you can pay out the utility bills separately, are going to be huge. We're really big into the dual income property space. I think it's going to make it much easier for investors to justify an investment, and it's going to make it much better for tenants because they're going to be able to get access to more product as opposed to one single house just providing one product for someone to rent. So two income streams on the one land parcel, a dual income property, a property with the granny flat, is going to be a very, very big way that investors approach, because of the obvious reason of wanting to generate more income now for investments without being able to get the same tax benefits as before if you're not buying a new home. And then key point 6 is the long game. Why investors who hold will win. I want to close the main content of today's episode with the most important mindset shift of all, because strategy without the right mindset will always fail. So population growth, for starters, is not slowing down. So the longer that we hold our assets, the more valuable that they're likely to become, because we have more people moving here than we have houses being built. which puts stress on that housing supply and demand component, which is one of the number one driving force of price, in my opinion. Population growth is not slowing down. Rental supply is critically constrained, especially if people, stop buying investment properties. That means that we don't have as much property for tenants who can't afford to get into the housing market or don't want to buy, will not have access to. Rental supply being critically constrained is a big thing as to why you need to be the one holding the assets. You are the ones that will be generating that income producing return that the tenants will need to pay, which is very likely to increase. As I said, especially if you've got two incomes on the one property, the return is considered or very likely to be a much stronger return. Timing the market beats timing the market. It's something that I always talk about. I think that structure and the strategic approach to the type of property that we choose now is much more important, but timing the market will always beat timing the market. If you time the market perfect, you get lucky and it just works perfectly for you, great. That means that you've made a decision, you've backed yourself, you've entered into the market, and you've been rewarded by doing so. It's the investors that panic, who sell to other investors who plan, that will lose out here. I can't remember the saying exactly. I think it's a Warren Buffett saying about wealth creation is the process of the impatient passing the wealth to the patient, something along those lines. So investors who panic and sell to the investors who wait and plan will be the ones that lose out from these changes. So bonus point, capital gains tax is now not discounted at 50% when you have the asset for more than 12 months. If it's an established property, if it's a new home, that still applies, which is very important. And we've got the capital gains tax benefits to self-managed super fund acquisitions as well, which are now more important to understand than ever. So that's my bonus point. And look, before we wrap up, there's one more piece of the puzzle that becomes critically important in a world with reduced negative gearing benefits, and that is the capital gains tax strategy. So as I said, when you sell a property at a profit and it's a new home, you will still get the 50% discount, providing that you've held that property for more than 12 months. You will also get the discounts in a super fund approach or self-managed super fund via a bare trust, but you will not get these benefits on established properties moving forward. You will only get capital gains at the index of whatever it is that you sell that property for. So the importance of never selling is more important than ever. We can use any growth within your portfolio and the income, especially if it's a higher income property like we talked about, to acquire more assets. And then as that asset base grows and the debt position reduces, even though your debt position's going to be increasing if you're acquiring more assets, which is a good thing because it's good debt, then we're able to use that equitable position and cash flow and tax offsets, if it's set up properly, to then be able to acquire more assets. And then there's different things that you can do with that, and that's when you start seeing people acquire more and more and building bigger portfolios than ones who do not have a foundation, and you can leverage a really substantial matter. So never sell, setting up the structure, very important. And, new homes with dual income opportunities, I think will be a really, really big thing for people to look at. If you want help with that, absolutely, that's something that we've specialized in. These changes have actually helped our business quite a lot. I don't agree with the changes, but government is government. I think it's a private market that needs to work together to be able to help each other grow and get ourselves going. So let's bring it all together. The negative gearing changes are real, they matter, and they require a strategic response. But they are not the end of property investing in Australia. They're a reset. And for the prepared investor, a reset is an opportunity. So here's your investor playbook in plain terms. Firstly, understand exactly what has changed, and stop relying on media headlines for your financial strategy. Audit your existing portfolio and identify which properties are exposed. Point 3, shift your focus towards cash flow positives or cash flow neutral assets in markets with genuine growth fundamentals, and you will put yourself into a position, especially if it's structured correctly, where you will win. So that's the end of the episode. I'm extremely glad. Hopefully you liked it. If you did like it and you would like to share some love, please like it. Please subscribe, leave a comment, share it with a friend. That would mean a lot to us. We're genuinely here to help people do well through property, and this education's been made for free to as many people as possible. And we do get a lot of good feedback from our clients that work with us to say that the podcast has helped them make a decision to work with us. So thank you very much. I hope you enjoyed the episode, and I look forward to seeing you in the next episode. Goodbye.